This time it's different. And I think the bubble is topping. Our metrics of the bubble, meaning momentum structural analysis of the US stock market. We think it's at or near the trigger points. In fact, if you sneeze between now and get into January, you're going to have a sudden change in tone and direction of the stock market, which will surprise people. And this is the biggest bubble in US history. So when it breaks, expect the depth to be serious, but the recovery to be protracted. What has benefited in each of those time periods? Gold.
Hello and welcome back to Soar Financially. My name is Kai Hoffman. I'm the @JR Mining guy over on X, and of course, you're a host of this channel, and I'm the host for this conversation, which I'm very much looking forward to. It's with returning guest Michael Oliver. The last interview we've done with Michael was the best performing video on our channel, and I'll tell you why. We talked gold. We gave a gold price prediction of $8,000, which people didn't take too kindly to, but also we created a bit of urgency, and we were right to do so because gold ran about 10% after the interview, and lots has happened since. So it's time to catch up with Michael, but also this is part of our 2025 forecast and outlook series. I'll be asking Michael a lot of forward-looking statements here, or to ask him to make a lot of forward-looking statements. We'll both get our crystal balls out and look into 2025, as it is the year end, and we do have to look into 2025 in particular. One question, Michael, I'm mentally preparing you for is I might ask you about how people should invest their 401ks the next 2 years. It's a question I've seen below one of our YouTube videos, and I do curious what your thoughts are, Michael. Just a heads up before I switch over to you. Quick reminder, please hit that like and subscribe button. It's a free way to support our channel, and we tremendously appreciate it. Thank you so much. Now, Michael, it is great to see you again. Thanks so much for joining us again.
Good to be back.
Yeah, we got lots to talk about. Lots has happened since our conversation. I created a bit of urgency with our YouTube title and thumbnail last time, meaning gold, 3 weeks left, and time is running out. Fed cut to mark the top, $8,000 gold, question mark. You know, a bit of a clickbaity title, but I don't think we were too far off because we're about 2 weeks away from that first Fed rate cut back in September, and gold has moved. Gold has moved over $200, almost 10% after our conversation, Michael. Has anything changed since late August now?
No, we still have a gold and silver, and the miners have come out of a congestion zone, well, especially gold and silver, congestion zone that prevailed for about 3 years. And for gold, it was sideways. For silver, it was a staircase to the downside. And they both broke out in March, and we give a major resumption signal, let's put it that way, not a fresh buy signal, because originally the trend started in February 2016 by our metrics. But it was a renewal signal. The congestion's over, going up. Okay. At that point, gold was moving out above 2,000 yet again, which it had done several times before, but this time it was different. We knew it would go somewhere. Silver was moving through 25, 26 zone, and since it's seen 35, right now we're trading 31 and another pullback. So we still have a process of upside, but it's still replete with those pullbacks. You know, gold will go up 3 steps and pull back 1. Silver will go up 4 steps and pull back 2. You know, they're far more volatile, nasty little dog on a leash. The leash is held by gold, so never forget that. But on the upside, silver beats gold. Now, by the way, I just want to make a point to people who think the stock market is king right now. Gold and silver is up as much on the year as the stock market is. Go figure, okay? Nobody talks about that. Percent-wise, year to date, how much up? Okay. Despite the recent pullback in gold and silver. So somebody's buying this stuff. Yeah, there's dips along the way, sharp dips. Now, the question is, when will gold not just engage to the upside as it has since March, out of that zone of, boredom, but when will it engage in a more vertical manner? And we've been arguing all along that as the asset classes shift direction, that's what helps fuel gold. But gold doesn't wait for the events. I don't think gold waits for headlines. I don't think it waits for Fed policy. I think it knows what's coming. I think it knows we have the biggest stock market in the U.S., biggest asset bubble in the history of the United States, at least going back to the early 1900s, in terms of the dimension of the stock market bull, number of years, the percentage gain from the prior bear low, beats anything we've ever seen. Beats the 29 bull market, mid 70s, the dot-com, the 2007 peak. None of those advances were won as long as this one has been. This is 15 years now since 2009 low. And the dimensions. Now you can say, well, the economy is much better. Well, you're great. If you want to believe that, that's fine. Look at the money supply growth over the last 15 years has been more than any other 15-year period. Okay, that helps fill the tank. And look at the money rates for the last 15 years. They've been at effectively zero 10 of those 15 years. And yeah, we had some upticks here recently to still moderately low levels when you look historically at Fed funds rate. But that's helped fuel the bubble. The problem is, in the past, anytime a bubble has occurred in the U.S. stock market, and historically we look back and say, well, 29 was a bubble. Okay, so it fell apart. Oh, no big deal. .com, it was a bubble. So NASDAQ dropped 82% after that in the next 2 years. 2007, we had a mortgage crisis. It collapsed 50% in the S&P in the next 2 years. This time it's different. And I think the bubble is topping. Our metrics of the bubble, meaning momentum structural analysis of the U.S. stock market. We think it's at or near the trigger points. In fact, if you sneeze between now and get into January, which is not even 2 full weeks away, really, because there's some holidays, you get into the next quarter, and we have some trigger numbers that are so tightly below the market that if you hit them, you're going to have a sudden change in tone and direction of the stock market, which will surprise people. I think gold is waiting on that before its next more accelerated upside phase. Why? 2 reasons. Once the stock market breaks, many assets will begin to flow out of that category into something else. And as I said, right now, if you're an asset manager and you look at monetary metals and you look at the stock market, you say, well, the stock market's been doing great, but how come gold's up as much as the S&P and the NASDAQ, even on this dip year to date? Something's going on there. Even if you don't understand it, as an asset manager, you see another place to be. So once you punch a hole in that beast and it starts to flow, it flows somewhere. And historically, it's always flowed. Go back 100 years. Anytime you've had a major bull market peak in the stock market and a bust, sometimes a very protracted bust in terms of time, gold has advanced during that time. And I think that's what gold is now waiting on.
No, very, very good succinct analysis here, Michael. Like a couple follow-up questions, obviously, to that, and maybe we'll start with the correlation between the Fed and the Fed funds rate and gold. I'm curious about that. You touched on the Fed briefly here. Do you see a correlation and the statements made by Chairman Powell and the gold price, how it's reacting, or am I just imagining things here?
I don't think it does. There's many times where the Fed will be at a rate increase and gold will go up. Go back and look at the mid-70s, 74, 75. Late 70s, 78, 79, and 80. Gold exploded, and yet they were raising rates the whole time. Okay? The Fed is a primary generator of the boom-bust cycle. The boom-bust cycle we see in stocks, they create boom-bust cycles in monetary policy, which has real-world effects, not just the stock market, but in everyday lives of people and the cost of goods and so forth. They don't mind inflation in the stock market, but they mind it, they say, when it's commodities and it causes people to be painful when they go to the grocery store. But Powell has made it very clear, and over the last several months, that his focus is now on the other mandate, that is unemployment issue, the economy. He thinks they've done well enough on the, quote, inflation issue to now shift to the other mandate, because he sees that internally, if you look at the job numbers, they're not what they appear to be. And plus, the unemployment rate is actually upticking now, not in a dramatic way. But if you go back and look at major bull market peaks in the stock market, 2000 top, 2007, and look at the unemployment rate and see, well, it really didn't get into dramatic upticks in unemployment until the stock market actually broke in a demonstrable way, where people said, oh my gosh, this is stopping out. At that point, that's when the data points that the Fed likes to look at start to shoot up or shoot down, depending on showing a weak economy, a bad job market. And Powell is focused on that. He's made it very clear that that is his prime focus now. So I have no question that they're going to cut rates again, this week. But it also needs to look in the stock market over the last 2 weeks and now into the third week. Look at a NASDAQ 100 behavior, which has suddenly become the leader again, gotten strong, but in a very narrow way. A lot of this is the semiconductors. It's not NVIDIA anymore. NVIDIA is starting to actually break down in a way that could be very significant. We look at momentum now primarily. And nobody's noticing that too much. And so NASDAQ has stolen the limelight and has helped keep the S&P firm. But when you look at other sectors of the stock market, the non-tech sectors, you go back 3 weeks ago, over the past 2 weeks and into this week, look at XLF, the financial ETF. Look at XLV, the healthcare ETF. Look at XLI, the industrial sector ETF. Look at RWR, the commercial real estate ETF. Punch them up on your screen and just look at the price chart the last 2.5 weeks. And then punch up a NASDAQ chart for the last 2.5 weeks. They're in a different universe. The NASDAQ is living on its own. These core sectors of the market are dramatically off the highs, post-election highs. And in some cases, flat on the month and in very close jeopardy when they open next quarter, again, a week and a half away or so, to blowing some major momentum trend structures that we've defined to where they go from sort of happy up to whoosh, suddenly what happened? So it's something to be watched. And I have a suspicion that before the end of the year, we're actually going to get a bit of a sell-off. Not anything that alarms people in the stock market, but the kind of thing that puts price into a position on the S&P and the NASDAQ, for example, such that my momentum trigger numbers, breaking three-quarter average momentum structures that you can very clearly see on an oscillator, not on a price chart, breaking these massive structures, but only takes a few percent off the current levels to do that. It wouldn't shock me if by the end of the year, we're that couple percent off the high, ready to break in the next quarter. In which case, I think that's when the extra fuel, goes into the monetary metals as the money flows out of that broken asset category.
You touched on the trigger points, and I've written it down. I wrote down a question earlier to ask you about the trigger points and maybe define them a little bit and how you come up with those trigger points and what they potentially are without giving away the secret sauce here, Michael. But if you could, you touched on that a little bit just with your previous just last couple sentences here, but maybe you could define it just a little bit better for us so we can follow along.
In 1987, I was a futures broker. I was one started in 1975 after gold was legalized. In 87, I was still independent futures broker. And I caught the crash. I didn't catch it in a big way. It didn't alter my life, but it taught me a lesson. In other words, I bought some puts, okay? And so the crash, how did I catch the crash? When you look at a price chart of the S&P in August, September of 87, you were up making new highs out of you sort of been in a distribution zone or congestion zone on price where it stalled. And then you had this breakout, quote unquote, where you surged up into August, September. But later in September, you started to wobble off. It's again, the last month of the quarter before the numbers shifted in the next quarter, October, November, December. You shifted off the high just enough that when you opened the next quarter, October, the momentum charts, price was still looking okay, just a little dip, no big deal. But what the momentum showed, and here's what I did. I measured the monthly ranges of the S&P 500, the high-low close, and plotted them as a percent above or percent below where the current three-quarter moving average was in that given quarter. And when you plot that kind of chart, you get an oscillator, which is different from the price chart. You have your monthly bar price chart that looks like happy upside, but quarterly momentum built the floor over a period of about 2 years. where you'd pull back to the same level on the oscillator, you'd bounce. Pull back to the same level on the oscillator and bounce. Same level and bounce. So when you looked at momentum, you see a floor. On price, you didn't see that floor. And when you closed out the month of September, end of the quarter, third quarter, the 3-quarter average jumped up for the next quarter, moved up. Because why? Price had been going up, so the moving average moved up. So in effect, the numbers came up from below with the danger numbers, the breakage numbers. If you got down and broke below certain levels in relation to that new 3-quarter average, you broke that structure. And we did, like in the first week of October. And by the second week, we crashed. Now, you don't have to crash in these events, but we had the same exact pattern. We had this in our last weekend report to show that, make the point. In the 29 top, it was an overlay of the 87. Now, the ultimate outcomes were different because certain other factors, such as annual momentum, and I won't get into that right now. But right now, the NASDAQ 100 especially, and the S&P 500, when you look at their quarterly momentum, you don't see what you see on the price chart, which is a happy chart. Instead, you see a market that is hugging a structure repeatedly on momentum. If it were a price chart, you'd be spooked because you'd say, oh, I better not break that line. But you don't see it on price. We see it on momentum. And when you get into next quarter, those number gear wheel will shift such that those trigger levels will adjust up. And like I said, they're right below your feet in terms of price levels. So that's where the ambush occurs. And that's the way you move money the best, is when you ambush people, not when you slowly move them, but when you smack them with something they didn't expect. That is the fuel that will generate two things: movement of money into some other category, which is performing well, and that's gold and silver year to date, and cause the Fed to panic even more. So that's what we're watching the stock market for.
You mentioned the Fed panicking, which is perfect because that sort of segues into the next question I have. And I'm personally trying to understand why the Fed would cut rates in about 48 hours after recording. It's actually exactly 48 hours as we speak here, Michael.
Yeah.
The market expects, or 99% of the market expects a rate cut. And I still believe I'm part of the 1%. Why would the Fed cut? And maybe you can help me understand it, Michael, because I look at the unemployment numbers, just to maybe give some context to our listeners where I'm coming from. I look at the unemployment numbers. They're steady, right? Jobs report about 10 days ago. Nothing spectacular. It was within expectations, but the inflation number ticked up. And why would you cut into a rising inflation rate? So I'm curious what your thoughts are, Michael.
Because he's already said he would. Powell has made that, and when you listen to his talks for the last couple rate cuts, September and then recently, even before September, he said we need to start focusing on the economy and the job market. And the job market has been deteriorating because it's actually been upticking. We're up to 4.2. I think we were in the upper threes. No big deal. Again, it's not going to be a big deal until the stock market breaks. That'll generate the negative data points. But when you look inside that job market number, what categories is the job growth occurring? One, it's more part-time as opposed to full-time. And second, it's in healthcare services, home care services, hospitality, bartenders, waitresses, nothing. Yeah, it's a good job, but fine. It's that sector of the economy, and government. Those are the three primary categories that have been reflecting job growth, not industrial, not transportation, not what you might consider to be key core economic sectors. So the job growth has been masked by, one, where it's occurring in the economy, the temporary nature of a lot of the jobs, and also a heavy emphasis on government job growth. Now, maybe under Trump, that government job number is going to suddenly start to drop, which will affect the overall unemployment number as well. But he sees the upticks. And I think Powell is smart enough to look underneath the surface and see what categories are growing and which are not growing. Some are actually declining in jobs, some of these core industrial type sectors. So the job market is not as good looking as people like to talk about, especially the past administration like to tout the job market. Internally, the numbers do not look that good. And there's also been economic data points that are softening. Nothing sharply. No, that's not going to happen until the stock market starts to break. But Powell recognizes that, and he keeps telling us over and over, sometimes subtly, sometimes overtly, we're shifting. We're focused also on the other mandate. They think they brought their inflation down enough. They're going to be shocked in 2025 as commodities start to soar again. But the problem then will be that they have to focus on the job market. So they're going to have to ignore the, quote, inflation numbers, which, again, they look at distorted notions of inflation anyway. Real inflation is monetary growth, which they ignore. But anyway, so that's my assessment.
No, appreciate it. Thanks so much for clarifying. Like, I've been, trying to read up on the matter and trying to understand what the issue is. Like, why would he cut in the current environment? But it makes perfect sense the way you explain it. And there's a bit of like shelter inflation is one topic that's come down or one part of inflation that's come down as well, which is probably making the Fed a bit nervous. So they're trying to actively maybe promote the economy a little bit, I guess, right? Let's get our crystal ball out for the first time here, Michael. Looking into 2025, if we go off the last dot plot, we could or should expect maybe 4 rate cuts in 2025, so 100 basis points. What are your expectations for next year?
Well, as far as rate cuts, they will be more aggressive if the stock market breaks. Because if the stock market breaks, particularly some of these very relatively anemic sectors, no, they've been up with the stock market, since the 2022 low, but some of them have been up very lamely compared to the S&P. They're not even above the 2022 highs, for example. I think even the small cap index, Russell 2000, basically is crested near the 2022 highs, whereas S&P, NASDAQ are above them. But within the market, like the sectors I mentioned, the financials, home builders, another one, real estate, especially commercial real estate, are reflecting a relative weakness that is bleeding obvious. You can even look at the price chart for the last couple of weeks, for example. Well, everybody's been beating their chest about new high, new high, new high. And these guys are going down, And why? What's going on? These are sectors that the Fed can't ignore, especially the big banks. Now, if you break that real estate sector, the commercial real estate, RWR, VNQ, the ETFs to watch in that regard, that's big stuff. That's going to have wave impacts, especially in the financial sector. But it's not just that, it's healthcare. Healthcare has been one of the better performing sectors price-wise in the bull market because like from 2022 high when the stock market had its big, 20 some odd % pullback, XLV, healthcare sector ETF, basically went into a range-bound situation, didn't suffer as much at all as the stock market, so it was a happier place to be. And it also went up and made a marginal new high recently. But it's starting to sink back toward getting back down into that prior multi-year range, which is not a good idea. Not only does it look negative on a price chart to do that, to pop back down into the prior distribution zone, but it'll break quarterly momentum. So too many sectors look extremely vulnerable. And all it's going to take for S&P and NASDAQ to become very vulnerable is, like I said, a couple % drop from where you are right now if it occurs before or during next quarter. I think the floor will come out. Anyway, that's going to be the dramatic event. And I think that's when gold starts to get refueled again.
Without getting political, of course, it's always difficult. But Trumpflation, how much of a factor does that play for you? Like, how do you calculate that? How do you forecast for that? How does that fit into your models?
It doesn't fit into my model. I know he's made a lot of promises, and he's got a few people around him who are genuinely free market type folks. I would say, Vivek Ramaswamy, Elon Musk. Many of the others are, more mainstream, actually, if you look underneath the surface. But anyway, he wants to go in the, quote, right direction. The problem is that we've had, nearly 100 years of constant growth of government control over this, that, and the other, but particularly the economy. Started with Hoover, actually, not with Roosevelt. In 1929, for example, 1 month after the crash, October and November, Hoover called together industry and government together, and they started like pumping the money, so to speak, having construction projects and anything they could do to spend money to keep the labor force steady was his goal. And all the things he did, if you look at the enumerated things that he engaged, really were precursors to the New Deal. So, but from that point forward, especially under Lyndon Johnson, the war on poverty stuff, the government has grown and created more and more policies to stimulate and cause the economy to look good at times. And anytime there's a bubble break, they go crazy in terms of printing money and going more into intervention. Now, Trump says he wants to reduce and go back to a more limited government. Fine, great, super. But you punch a hole in a bubble as big as we've got now, it's not going to go down quietly, no matter who's president, what their policy is. When that bubble breaks, it has an integrity and a dynamic of its own. If you go back and look at the 2000 dot-com top, where NASDAQ led the way up and S&P followed. But the Fed cut rates in January of 2001, when the new president came into office, by the way. They cut rates twice in January of 2001. Well, in 2001, January, you weren't really that far off the high in the S&P. You weren't in a dangerous looking position, but they cut rates twice, and they cut rates for more than 2 years on the downside, sharply. Did that stop the collapse? No, NASDAQ dropped 82%, NASDAQ 100. 2007, at the top month, September, but just before the October high, in October of 2007, Fed cut rates 0.5 basis point, out of the blue. And yet they said, oh, there's no mortgage crisis, yet they cut rates 0.5 point. That was actually unanticipated. So the market went up in happy tone into October, peaked in October and started down. They cut rates all the way down to 0 during that collapse and continued them there. And yet the market still collapsed, creating, disastrous real world effects for average guy in the street, not just stockholders. So rate cuts don't stop a bubble from breaking, and a shift in Trump's policy. If you're going to change reality, as he says he is, well, boy, the reality has been ongoing for decades. More and more government, more and more Fed control, more and more monetary expansion. If you change that, it's just going to exacerbate the bubble break. It's going to speed it up because the market will need to cleanse itself from abnormal reality. And once reality takes over, to expunge the errors of decades of false spending, false assumptions about what interest rates are. Families make decisions based on, what's the cost of building a new home or building a new factory for a company or building some roads for a state government. All these, that's a cost factor. If you're teased into thinking money rates are going to stay low, as they have been for 15 years, either 0 or single digits above, then you make errors. And once those errors get exposed, it's like hemorrhaging, okay? And you can't stop that. It's reality. So Trump is going to walk into hell, regardless of his intentions and an intended long-term direction. The events will take over. And I'm sure some people on the other side would love to see that, so they can blame it on him. The market was good up till Biden left office, and then Trump, suddenly things went to hell. See, he caused it, right? Anyway, no, there's an underlying reality there, and it's going to expose itself. That's what our analysis strongly says. In fact, almost insists will happen.
How do you account for government intervention? President-elect Trump said, I might be taking a closer look at the interest rates and what the U.S. should be paying. I know it's more complicated than it sounds. Yes. There's a process involved, but does your model account for that at all? Let's call it maybe a black swan government intervention or so. I don't know.
I could philosophically look at that and see how it fits into the long-term picture. But if you try to take away some of the government interventions in the economy, to some extent, you're going to be helping punch further holes in a bubble that has been created by that process. So, some of these aspects of the market that have gone up artificially, if you remove the thing that helps support them, you might help deflate that false pricing. So to some extent, it could be healthy, but sometimes healthy means, expunging or puking up what doesn't belong there. And he might actually help that along.
So you might shine a light on it.
Yeah, right. Well, he even said during the campaign, the market's going to crash. Well, it hasn't. And it wouldn't be surprising that it does, but it doesn't once he takes the oath or just before. So I don't think his policies will alter this. In fact, they could exacerbate the speed of the recovery. And by recovery, I mean getting rid of the bad stuff in a rapid way rather than a delayed way, rather than a slow healing, have a rapid expunging of the errors, and then, take some years to reheal in a positive way. In fact, we're about to come out with a major report my son has produced, be this week, I think, looking at long-term investment assessment in the U.S. market for going back 100 years. And people seem to think that, you get a 2-year bear market, buy it, Well, in fact, that's true. But a lot of the bear markets, which are 2-year drops, 2000 to 2002, you had 82% drop in NASDAQ. 2007 to 2009, S&P went down 50%. 29 to 32, 2-year drop, really. You went down off the page. It was like 80% collapse. That wasn't the issue. It wasn't the duration of the bear. The problem was in getting back up to, if you're an investor and you didn't get out to avoid the collapse, waiting to come back to break even again took a decade and a half or more in so many cases that it's common. So even if you look at, let's say, just pick NASDAQ in 2000 top, it broke 82% by late October of 2002. Was it a buy there? Yeah, sort of nominally it was. But when you factor in the decay in the money supply, the increase in the money supply, the decay in the value of money, so even if price goes up, this isn't really going up. But even just to nominally get back to the price high of 2002, for the NASDAQ 100, it took till 2016 for the NASDAQ 100 to regain the price it saw in the year 2000. So from an investment perspective, one needs to be aware not of the notion that, bear market, it's over quick, get long again, the game's on. No, it's not, especially when a bubble breaks. And this is the biggest bubble in U.S. history. So when it breaks, expect the depth to be serious, but the recovery to be protracted. What has benefited in each of those time periods? Gold.
Michael, I think in our previous conversation, you mentioned that people should consider reallocating to precious metals, like you've just mentioned, or bonds. And when you expect a market crash potentially to happen, maybe in the next 12, 24 months, we don't have to put a timestamp on it. But are bonds still the place to go right now? And maybe as a part B to the question is, do you expect negative rates again in that?
No. Forget the short end, the Fed fund. You go out to the 30-year and it's a different monster. It doesn't even care about the Fed. In fact, if you look at T-bonds, when the Fed cut in September, they peaked and went down. What did the stock market do? Shot up, since the Fed rate cut. So T-bonds went down, meaning yields went up on the 30-year. Fed funds rate went down. The T-bonds don't care about the short end of the market. They're the long end. They're beyond the Fed's control. And that's reflective of a major bear market underway in U.S. government T-bonds, meaning an ongoing rise in yields. The problem is that, technically speaking, if you're a bear in the bond market and expect, a government debt crisis to come because of, the government debt ratio to the GDP, the increase in government, it's all those numbers that we all know. Yes, that crisis is coming, and yes, it could lead to a disaster in the bond market. But from our technical point of view, we see a counter trend rally potential in the T-bond market, meaning a drop in rates and a flush into the T-bonds. When the money moves out of the stock market, our bet is, you break the stock market 2% off its high, I'll bet T-bonds are starting to surge. Now, already bonds have tried to come up off the low of a month ago, and they've come up fitfully, sharply, and then pulled back, and they're still fitful. But we think that there's a counter trend sharp rally in T-bonds, but it is not a sustainable trend. It is a trading situation. So don't treat it like you would gold as a, quote, alternative that will last. It might be a trading alternative in the initial months after stock market breakage becomes obvious, where people flee and they go to what? Hey, T-bonds, right? That's safe, okay? It isn't, but for a while it might appear to be. And gold. So I wouldn't trust T-bonds beyond a nice trading rally, which of course would what? It would upset a lot of the people who have a fundamentally negative view of T-bonds, and they're correct. The problem is even trends can have counter trend moves. and I think T-bonds will have one. It is not a safe place for an investor to be. Gold, I think, is, and monetary metals, and the miners, dogs that they are.
We'll get to those in a minute. I got a few more questions for you on those. I tried to squeeze in a part B of my question. It was a bit misplaced, and I'll throw it in now because I got a question underneath one of the YouTube videos, and he asked, is it possible the U.S. will see negative rates? And I'm curious what your thoughts are on that. Could there be potentially an over-exaggeration by the Fed at some point?
Could be. I mean, the short end of the market you're talking about, yeah, they could go crazy again and go back to zero or whatever. And let me remind people, Trump, back in the latter years of his administration, when there were rate cuts going, he argued to the Fed they need to cut rates below the Europeans, get it to zero if you have to, go below zero. Should have cheaper rates than the Europeans. So he was pounding on the Fed to cut rates more than they, So that's sort of contrary to our notion of Trump today. Now the question is, if we get into a down stock market, will he again turn to the Fed and demand that they cut rates more so than they already will be doing? I don't know. It'll be interesting to see, because that again is not moving away from government intervention. That's increasing government intervention in the sense of, I want the government to control the price of money, an essential commodity in everyday life. Okay. Money is an essential commodity between you and me. If we transacted business or a grocer or, whatever, I may not know the person I'm dealing with, but I'm making a transaction. He likes it. I like it. We make a deal. But if that money is degrading rapidly in terms of its buying power, and as more you increase the money supply over every decade, it decreases rapidly. For instance, since 1950s, the money supply every decade has basically doubled, almost. Doubled. That means if you bought a stock at $10 and 10 years later it's at 20, you haven't made a penny, And if it's gained more than that, then you've lost money. So you have to factor that in. So to, again, insist that the Fed take over the cost of money and make it lower than what the market might otherwise do, God knows what level that would be, that is in effect government intervention. So we'll see, but no doubt the Fed will cut, and I suspect Trump will encourage them to.
Before we get to the mining stocks, Michael, I have two more topics.
Okay.
One is a smaller one. One might be potentially bigger. We'll find out. You touched on the Eurozone, and I always get complaints in my interviews. I'm German. We never talk about the Eurozone. What are your thoughts on the Eurozone right now, economically, on the markets, and going into 2025 in particular?
Well, I don't keep up with the economic data that closely. I mean, I hear what you hear, and anybody could hear on financial, but I know that Germany is suffering. Okay, it's the core economy in Europe. And we've run the DAX index recently, and it looks vulnerable to a downturn. Major downturn. There's a difference, though. When I look at China, for example, which is suffering from recession or possibly worse, primarily coming from the real estate markets and so forth, the government's trying to stimulate that back up. But they do not have a bubble, a stock market bubble, that is. So they may have a bubble in the real estate market that's breaking. When you look at the Shanghai Composite, go back to 2009, you're right now not even double the price of them. You look at the DAX, go back to 2009, it doesn't compare to where S&P is versus 2009 or NASDAQ 100 versus 2009. So while those markets might weaken and go down in, coincident with the US market, we have the bubble. Now there's two other world economies out there, India and Japan, who have a similar technical bubble that we do in their stock markets. There was the Nikkei 225 and the Sensex index. They are also very bloated when you look at price charts. So they have big bubbles in terms of price. And they have equally vulnerable quarterly momentum breakage points in their face when they open next quarter. So that if we do break down, we're going to have sympathy from some other markets, particularly the two others that look like bubbles, so Japan and India. But as far as Europe goes, it's simply not a bubble in the terms of that we are. So if it breaks down, it's not going to be as big of a stock market disaster as we will be. Same with China.
Okay, no, appreciate that. It's like I often get the comment below the videos like, "Oh, Kai, you never talk about the Eurozone," so might as well throw that in. And the last topic before we get to the mining stocks, because it ties it together a little bit, is the U.S. dollar. It has been rallying a bit since the U.S.
Yeah.
election. I'm curious what your outlook is for the U.S. dollar here, Michael.
Well, we're pending major bears. Now, what I mean by that is when we go out even further than quarterly momentum, we go to annual momentum, like plot the monthly bars of the dollar index going back 20 years or so against the 3-year moving average, and you get an oscillator. Doesn't look like the price chart. Price chart has a upward staircase, so to speak, although we're well below the 2022 highs in the dollar index. It was 115 then. I think we're 106, 107 right now. But when you look at 3-year average momentum, there's a trend structure you can clearly define such that it says you get into next year and you close out a month below about 104 on the dollar index, a couple percent below where you are now. You're going to blow that structure, in which case you're not going to be quiet anymore in the dollar. The dollar has been quiet since early 2023. After it collapsed from that 2022 price high at 115, it dropped down near 100, and it went into a range from about 100 to 108. Most of that range really in about 5% range, most of the action. Right now, we're still in that range. So really, for the last 2 years, the dollar's been as boring as hell. It has not been a dynamic asset factor in terms of moving this market or that market in a direction or influencing the movement. It's been boring. Yeah, you get little rallies, you get little sell-offs. People, oh, look, it's going up. Meaningless. It's just at a dead zone, okay? And I'm saying at 104 or lower next year. 2 weeks away. You don't want that dollar index to be 104. And then we go to a 10-year average momentum, really long term. It has even more massive uptrend structure where if you looked at the 10-year momentum oscillator, which we publish in our reports occasionally, you see a trend line that you can't see on the price chart. And it says you get down in the 102s, it's over. So I got a dynamite level at 104, one another in the 102s. These are all within the range of the last month or so. You do that next year, and you're going to blow massive long-term momentum trend structures that argue dollars collapsing again. And so suddenly the dollar, which is the boring asset category for the last couple of years, is going to not be boring anymore. And it's going to have wave effects on other markets.
The mining stocks.
Okay, mining stocks.
We got to talk mining stocks, Michael, because it ties it together a little bit with my sentiment question that I asked you earlier about the Fed and the gold sentiment. Because personally, I've seen it firsthand in the junior mining stocks. Mm-hmm. The second the Fed cut rates in September, everything was fine. There was almost euphoria in the markets. We've seen money come in, and maybe it was the U.S. election, maybe it was the Fed in November, but maybe the bearish tone or hawkish tones of the Fed there in. Dovish tones. Saying they were more data dependent in November sort of put a halt to everything and just screeching halt in the junior mining space at least. Euphoria disappeared. So I'm curious what your thoughts are. What are the charts telling you? Your charts versus my gut, Michael.
First off, look back. 2015 low in gold was just above 1,000. It's now 2,700. Okay, so you can do the geometry on that. Nice move. 2015 low in GDX, I think, was $15. We're trading 36 right now. Yeah, it's a pullback. We got to a 44 high recently. We got to a 45 high in the mid 2020 rally. So we basically went up and sort of double topped, quote unquote, at the 2020 high. They sold it a point or so in front of that high. Let's sell it here. Where's the difference? And you got to sell off because gold sold off. And the sell-off spooks everybody. But if you just punch up a monthly, you don't have to do momentum. I'm arguing that long-term momentum on GDX, for example, or XAU index, which has greater history. You run quarterly momentum and draw a trend line. You don't have any structure nearby that is viable to break. You have a structure below that is likely support if you get there, which is not far below where we are right now once you get into next quarter. Likely support. But they're not developed for a major downtrend. They're simply in a downturn within the context of a strong momentum upside, which is not mature enough yet. Yes, they're a laggard to gold and they're a leader to gold. There'll be times where the GDX for 2-3 weeks will beat the pants off gold and suddenly it'll get weaker than gold, percent-wise. And that's when everybody pulls their hair out and says, it's no good, it's not going to follow gold. It will follow gold. That's the one principle you got to keep in mind. If gold is steady and up, forget GDX, it's going to flip up too. flip up out of what may look like a nasty hole, but it's going to flip up. But even when you look at a monthly price chart of GDX, go back a couple of years and look at the action. We gave a re-entry point. It was like we did on gold coming up through 2000 in March. We did on silver 25 to 26 level back in March. We said, okay, if you're not in, get in now because we're going to have another surge. GDX then was 3150. And we urged, if you're not in them, this is a time to get in them. Well, they went from 3150 and now on this quote sell-off, we're at 36. Well, is it collapsing? No, it's still well above that entry point. And yes, it has had up and down, but the monthly price chart action for the last several months is sitting on top of the prior year and a half or 2 years of trading range on price even. And we're not even down testing that level totally. You go back to the peak monthly close that preceded the last 6 months of upside action. Price is even doing this, sitting on top of it, not breaking below it, just zigzagging, boring the hell out of people. And that's what it does. This is like the most prior bull moves in gold. You'll see there's periods when the advance is, 2 steps up, 1 back, or 4 steps up, 2 back, like in silver, and same with the gold miners. And it just bores people to death and spooks them constantly. And yet it's an ongoing upward process, despite the pullbacks. And then suddenly, late in the trend, you get this zoom effect where suddenly it's no longer 2 steps up, 1 back, or 4 up, 2 back. It's 8 steps up, 2 back. And it's at that point when suddenly all the people who doubted it are all the way long become entrenched bulls again. That's when maybe you get worried 6 months later that you could be making some kind of high for a while. But we're not there. And so what I see technically on the miners, even just looking at price, is, it's pulled back from the recent high, but you shouldn't have gotten long at the recent high. You should have gotten long at 3150 back in March when it broke through major, clear momentum structures. And price followed suit very quickly. And we're still comfortably above those levels. So you have to put up with these pullbacks. That's just the nature of the beast.
Michael, you said something that triggered a thought that I discussed on a panel with Christian Watzian at the Deutsche GOLDMESSE, and he said, don't be surprised that neither gold stocks or even generalist stocks have broken out because they're performing at the same level. You said it as well, like S&P and gold, S&P 500 and gold pretty much moved in lockstep, about 29%, 30% for the year. Yeah. So there's no inherent bias towards one or the other. They've been going up in tandem,
net
right?
On balance, year to date, that's true. But actually, in the intermediate swings during getting from A to B, we're talking about, there have been many contrary swings. In fact, there have been total contrary since September. And especially once we got into November. And look at the election. Election occurs, gold collapses, silver collapses. Let's sell gold. We don't need, Trump's going to deflate inflation. No more inflation. That's great. Super. Wand swung. And the stock market soared. And then after that event, stock market had a little questionable pullback. Gold had a rally. And then gold sold off again and stock shot up again. Totally opposite. And you can go back to September and see they're almost totally inverse to each other. So, in fact, when we run things like, let's say, weekly momentum of the gold, a shorter term, like what's price doing in relation to its 3-week average, or what's price action doing in relation to oscillated against its 65-day average, which is like a 3-month average. They're totally opposite the S&P. So as the S&P is building structures below to break down through that are very clear and very nearby. In fact, I'll start to break some of those structures if we close out any day this week back down around where we closed Friday. So that's how tight they are. Gold has similar structures overhead to break out through. So when you look at the momentum charts, you see a totally opposite potential situation pending, with the numbers not far away, to where suddenly if the stock market starts to break, even on just a short-term basis, which will, of course, lead into that quarterly break I told you about, gold has the opposite situation pending, where it goes up again, and this time we bet that if the stock market starts to break our trigger numbers, especially as we get into next year and break quarterly structures, we bet gold is going up this time, but it's not going to go up in that 2 steps up, 1 step backward process. It's going to go up in a more vertical manner. Why? Because the big baby is breaking and the money flow will start to move into gold.
No, fantastic. Maybe the last question, Michael. Is there anything else we should be looking for or looking out for in 2025? Anything that we haven't really discussed yet? Is there anything on your radar screen? It can be commodity or anything else.
Yeah, commodities. Yeah. Once the Fed becomes preoccupied with a weakening economy, which will occur once the stock market peaks, we think that's basically inevitable and soon. The data points will change and the Fed will have to shift to economic mandate, unemployment, et cetera. And the big banks will be banging on their door saying, you better shift to that attribute, that mandate. That's going to be a key factor. But the notice what's happened to the Bloomberg Commodity Index. The Fed claims great victory over inflation. Well, in early 2022, at the start of the war in Ukraine, that was late February 2022, the commodity explosion, which began in late 2020, from our metrics. We said there'd be a commodity explosion. Well, the Bloomberg Commodity Index doubled from our entry level was 70 level. It went to 140 by March of 2022. When the war began, commodities started to correct sharply to the downside. Now, and they collapsed by early 2023, the Bloomberg basically had finished its correction. Now, I know the Fed likes to say, well, we brought the markets down. Well, actually, the commodity markets had peaked and come down seriously on their own based on a need to correct. They just doubled in price over a year and a half. And since then, over the last year and a half or so, the Bloomberg Commodity Index has been dead sideways, a couple percent either side of 100, which, by the way, historically is very cheap. You go back and look at 2008 high, it was 230 something. And the 2011 high, it was like 170 something. And right now we're trading at 100 and people say commodity prices are through the roof. They haven't even begun. So as an asset category, it's still cheap. We argue that the sideways price action for the last year and a half is basing action. And when we run our quarterly momentum, like we do with the stock market, which indicates downside breakage, we run it on commodities like the grains or oil. Natural gas has already broken out, for example. And the Bloomberg, we see that like a percent or two above where you are right now, you're going to break these markets out to the upside again. So I don't give a D whether the Fed says they're concerned about inflation. If those commodities turn, they'll have an integrity of their own. First, because they're still dirt cheap, historically speaking, compared to past peaks. And once asset categories break, money flows into other asset categories. Well, there's a lot of stocks related to commodities, which will benefit greatly from a commodity upturn, particularly ag-related stocks. And so I think you're going to have, that's another place to be in 2025, is commodity-related stocks, which do not correlate well to the direction of the U.S. stock market, by the way. So don't be fearful of that issue. And commodities in general will reassert themselves. And what will help do that is, one, their cheap price, their technicals, and three, the Fed's going to start pumping money again. Well, that money has to go somewhere. And if it's not going into the stock market, once the bubble breaks, it doesn't work. That money goes somewhere else. Commodities are a cheap, low-risk area to be if you're an asset manager. So that's a place to be looking to.
No, fantastic. Michael, I have to trigger my audience a little bit. And very, very, very last question, I promise, is what happened to the $8,000 price target for gold?
Oh,
I know you only touched on it on the side.
No, I didn't
before,
mean to get there yesterday. I just said that the gold in the prior bull markets at eightfold moves is no big deal. Go back and look historically. 10-year swings here and there, eightfold from 2000 to 2011, $250 to 1920. Even from the 1976 correction low at $103, you went to $850 by 1980, 4-year period. Eightfold moves, it's common. It's no big deal. Look at a logarithmic scale gold chart. Well, our last bear low was $1,000. Okay. Well, given the things we've been talking about today, major asset class shifts, particularly if we have a major asset class bubble break in the stock market, the money will flow elsewhere. And the central banks will try to fight that best they can. And their only tool is monetary excess and artificially low rates. What's the primary beneficiary? Historically, it's always been gold. This time it's going to be gold again. And so to see gold make another eightfold move would be, so what? That's a norm. This time the crisis is going to be even worse. So, there's a lot of guys out there who are fundamental analysts of gold that I have respect for. They may not be good at timing, but they're good at their macro views. They're talking $20,000 gold situation. Wouldn't shock me. I think it'll go off the page. The key is to break the bubble that is pending in the U.S. stock market. When that occurs, all the dynamics shift, and gold won't go 2 steps up, 1 step back anymore. And again, $8,000 gold it's a norm. Okay,
No, fantastic. Michael, I just wanted to trigger my audience because they love high price targets because they usually never happen the day after our interview happens, right? We don't move up 100%.
8,000 is not a target. It's just showing what's happened in the past. I strongly suspect if you see $8,000 gold, you're not going to stop there.
Yeah. No, I think we made that abundantly clear in our previous conversation as well. But because I included it in the title, it triggered some people. So, but that's fair. Michael, what a wonderful conversation. Like, this was like this, how do you call it? Like, this just flew by. Like, unbelievable. I really appreciate it. Where can we find more of your work, Michael?
OliverMSA.com. MSA from Momentum Structural Analysis. We've been around since 1992, primarily providing research to institutions. And then in 2016, 15, 16, we opened it up to retail subscribers. And I hope they enjoy. We look at all 4 major asset categories and try to fit the pieces together, because you can't just look at gold and say, well, look what's gold doing. Look at what the stock market's doing. Look what the bond market's doing. Look what the dollar's doing. These are all impactful, icebergs hitting each other. So you need to have a wider view, and that's what we try to provide.
Phenomenal. Michael, I really appreciate your time. Thank you so much. Merry Christmas. All the best for 2025. I can't wait to catch up with you again in the new year, and to everybody else watching. Thank you so much for tuning in. I hope this was a fantastic, I hope you enjoyed this conversation as much as I have. I was looking at the time. It's 55 minutes into this conversation. I can't believe it. It just flew by. I tremendously enjoyed it. If you did so as well, please leave a like, leave a comment, and subscribe to the channel. It's a free way to support us. We really appreciate it. Everybody, Merry Christmas. All the best for 2025. Wishing you all the best, trading luck, and of course, protect yourself, educate yourself. That's the best thing you can do. Thank you so much for tuning in. We'll have a lot more interviews coming from our Outlook 2025 series. So stay tuned for more. Thank you so much.